Hello and welcome to another episode of the Opportunity Podcast. I'm your host, Greg Alfrani, the head of marketing over here at Empire Flippers. And today I am interviewing Denise Edwards. She helps SaaS founders basically get money. Like if you are building a SaaS business and you're trying to raise money, raise capital, whether it's dilutive or non-dilutive, Denise has the network. She's done it many, many times. Really interesting background. In a lot of ways, it kind of mirrors Empire Flippers, where her background wasn't fundraising initially. It was marketing and sales, just like EF. We didn't used to be a broker way back in the day. So very fun talking to her, very knowledgeable person. I think you guys will absolutely love this podcast, whether or not you're a SaaS founder. Like I think a lot of what she's talking about, where we talk about how to pitch investors, is relevant regardless if you're a tech founder or like raising money for a plumbing company or an e-commerce store, because a lot of it just comes down to like the fundamentals of how to build a good relationship with someone. So with that said, I'll stop talking and I will let Denise share her wisdom with you. See you on the other side. All right, everyone. Welcome to this episode. I have Denise Edwards with me. Denise, we were having a fantastic conversation right before recording, which always happens like, oh, I should have been recording this. But for people who are not part of that pre-recorded session, why don't you introduce yourself, who you are, and what you do in the world?
Yes, thanks so much, Greg, also for having me on. So, hi, everyone. My name is Denise Edwards. I'm the founder of SaaS Launch, so software as a service launch.io. We are a service-based business and hopefully going into a productized-based business where we actually help early stage founders with fundraising anywhere between the stages of pre-seed up until Series A. And we have different service offerings depending on where you're at with your raise. So, for example, for pre-seed stage founders, maybe solo founders, we have a coaching, consulting type of offering where we actually help you connect with investors and just do the full 9 yards. And then for later stage companies, we can help them with, our done for you service where we actually connect them with investors as well. But every stage has a different need. So depending on where the needs are, that's where we basically help.
Very cool business. How did you get into this? Like, what's your backstory? Like, how did this all unfurl?
Yeah, great question. I don't come from any, let's say, VC or investment type of background. I come from a sales and marketing background. So I've been in sales since my master's degree. So I finalized my master's degree in the Netherlands and in Spain. And so during that time, I started working in sales. And the reason why I started working in sales is because I was a very shy girl. And I knew in the future that I really wanted to I wanted to have my own business, but I didn't know what the business was going to be because I had so many interests. And so I thought at that moment, I was like, okay, you know what? Like, if I want to have my own business, I do need to hone in on certain skills, which is, communication, negotiation, speaking in front of people, public speaking, all those types of things. And so I was thinking, what's a job that just encompasses all of those aspects? And I came to the conclusion it's sales. And so I started my sales career. And then I worked for companies, technology companies such as LinkedIn in Ireland. I worked for Oracle, which is also one of the biggest tech companies, as an AE, an account executive. And so that's where the sales comes in, selling obviously the solutions to other businesses. And so from that aspect, I actually started the company in 2018. And the company started actually as a sales and marketing service for technology startups. So we actually helped with implementing what I learned working with these big companies into these smaller, let's say, startups. And so from there, what happened was that one of the clients that we worked with, they wanted to raise funds. But at that moment, I did not know anything about fundraising, obviously, because I come from a different background. And so I had to kind of study. I had to ask people in the industry. And then I actually also intuitively, because I'm a very big intuitive person, I just, implemented what I learned also from sales and marketing into the strategy with obviously the information that I got from the network. And that's where it actually started. We got them over, I think, 40 meetings, etc. And so from there, we started the fundraising service and more clients followed suit from there. And so we left kind of like the sales and marketing and then transitioned slowly into fundraising. So
You
it's
completely different company as you do.
right. Right, really. So it's fascinating because, again, I do not come from a typical VC or investment firm type of background, but I do think that is the added value that I bring because I have a different mindset and I have a different perspective in fundraising, if that makes sense.
No, it makes total sense. I mean, us at Empire Flippers, like we've sold well over 2,400 businesses at this point, but we started as an outsourcing company in the Philippines. Like,
Oh,
like
wow.
the whole company started that way. And the reason why we even got into business brokering is because we lost like our key client that made up like 80% of our revenue, which,
Mm.
as all my audience knows, should not build a business that relies on one person like that.
Exactly. Yes.
Very bad move. And so we had this whole team like, well, what are we going to do with them? Like,
Mm.
they like literally have nothing to do. So we had them start building like little Google AdSense websites like way back in the day. And we started blogging about it and selling them. And that led into the brokerage. But similar to
Wow.
you, like we kind of grew up in the M&A world, not knowingly like normal parlance of how people do things. So we just like came up with
Exactly.
our own way, which sometimes was better, sometimes was worse. But yeah, so I totally get it. I think that's cool. That's an awesome story. So let's go down into what you're doing now with fundraising. If a SaaS founder is looking at getting funding for their
Mm.
business, what kind of routes are available? Like, what is even possible for them?
Yeah, it really depends on which stage they're at. So let's look at maybe a pre-seed stage, right? So usually what we're seeing is that founders in the pre-seed stage, depending if they already have kind of a solution in place, and the solution, I say solution because that's from my technology world, but let's say a platform or an app or whatsoever. If they already have a solution in place, but they're not generating revenue, that's kind of like more in the pre-seed stage. Usually what we're seeing, depending on which country you're raising from. So I'll just give two examples from, let's say, Europe, North America, so Namer, or Europe. Pre-seed stages usually, so we have a current client now based out of Europe, out of the Netherlands, and they're raising a 500K round. It was 350, but now they want to raise a 500K round. They're more in the pre-seed stage. They do have a platform and they're just starting to generate revenue, right? So 500K up to a million would be kind of like, I would say a normal ticket size in Europe
Mhm.
for the pre-seed stage. If you're at the seed stage where you're already generating revenue, it's obviously more. Like the ticket size is higher. It could be anywhere between 1 to 5 million, really depending on what platform it is, where you want to invest it in, et cetera, et cetera. In the US, the ticket sizes are a bit bigger. So maybe a pre-seed stage company that's in Europe that is, focusing on maybe a 500K ticket size could go for, if they're in the US, they could go for anywhere between 500K and a million, for example, for the pre-seed stage, if that makes sense. And so again, it really depends on which location you're at. Sometimes what also happens is that a European company registers itself in the US as a US LLC, and then they raise funds from the US instead of from Europe because they know that obviously the US is a bigger market. Investors are just more, I guess, they see that, say that ticket sizes are just bigger than in Europe. Europe is usually a little bit more traditional. And so that's kind of like where the differences are. But it really depends again on what stage you're at. But that's kind of like what you can take into account.
Oh, no, that makes total sense. I have a lot of friends who are, European and their LLCs are American for very
Yeah.
similar reasons. So that makes sense to me. I'm curious on what are the pros and cons of doing this? Like, what does the SaaS founder have to be wary of when getting this funding from investors instead of just like bootstrapping? So like most of my audience, they're bootstrapping their businesses versus taking on investment. But I do know several of them that wouldn't be opposed to taking investment, but they're a little bit afraid and they're not sure like, well, why should I even do it? So talk me through that.
Yeah. So I always say if you don't need investment, don't take it. If you can bootstrap it your way and you can bootstrap it in the way that you get traction very quickly, perfectly. Focus on that. Investment is only, in my opinion, is only needed when, let's say, because sometimes a lot of founders need to invest in software and in development, and that's where kind of like the biggest chunk of that investment goes into. And that's usually in the pre-seed stage. If it's in the seed stage, they already have that kind of like platform already, but they're still wanting to generate more revenue. That's kind of like depending on which stage they're at. If you're in the pre-seed stage and you are needing investment to invest in the platform, that is a possibility to take investment. The caveat here is if you can make a minimum viable product bootstrapped, that's always better than taking investment. If the platform that you're building or the solution that you're building is really capital intensive, then you can think of taking investment, right? Potentially. and then obviously understanding what the caveats are, etc. If you're in the seed stage where you're already generating some revenue and you want to basically speed up the process, then investment is a possibility as well. But you can also think of non-dilutive investment, like that investment, right? So it's not always that you need to have equity investment from an investor. If you're at the seed stage and you want to just, increase kind of like or fasten the speed, then you can also think of non-dilutive investments. We also have non-dilutive partnerships, so that's also an opportunity for those types of founders as well.
Yeah, I'm glad you brought that up. So for my audience, Denise and I were talking about like a friend of mine. He raised a bunch of money when he was quite young, ended up selling the business, and basically had to go get a job and start like another business almost right away because it was so
Yeah.
dilutive. So I
Mhm.
think that this is a very important thing I think for my audience to get is like there are so many different types of fundraising. Like there's so many different ways to get capital. So walk me
Yeah.
through a bit of like what does the dilutive path tend to look like and what are the non-dilutive options?
Yeah. So when it comes to kind of like the dilutive path, it really depends again, like where you start with your raise. Like some founders in the pre-seed stage, they don't take any investment. Then you have, your full capacity, your full cap table, 100%, right? Divided on the founders. Once you go into that fundraising route, then you have to obviously think of what the percentages is that you want to actually, provide to investors. And this really depends again. Like we have a framework in one of the presentations where we have like the approximate percentages of how much equity you should give maximum at each stage. I don't know from the top of my head, but I think from the pre-seeds, and don't quote me on this because I do want to check, but I think pre-seed is kind of like maximum 20% or 15%. And then seed stage is also a percentage. The rule of thumb supposedly is once you have raised series A, that you still need to have, well, that's a rule of thumb, 60% equity left in the company. So if you take that into account, then you're going to think differently about how you're going to, provide that equity at each stage, if that makes any sense. We had, for example, a company based out of the US, and they had like the sports platform, very interesting. They developed it completely, etc. And then I think from what they told me is that they went through an accelerator program, and that accelerator program also gave them investment, but that accelerator program took 40% at their stage that they were at. And that was the first chunk, right? So I think they got diluted, and I think they were already in their seed stage. I think they got diluted to like 60 or 60+% from what I remember. And so that's a big chunk that you're already providing or giving away. So our advice to them was like to readjust or at least kind of like negotiate that percentage, because if you want to raise further down the line, then it's going to be hard. Like if you think about 60% having that at the end of your series A, then that's going to be very, very difficult if you're at the pre-seed or seed stage, if that makes sense. So those are kind of like things to take into account. Now with the non-dilutive or debt financing, it really is based on, and there's different partners that do non-dilutive, but it's really based on kind of like your cash flow. Some companies do it on cash flow, and then they give like 20% of, I think, the annual cash flow, for example, from what I understand. And then obviously some companies look at what the future forecasted cash flow is and then base that on that. And so then you just basically pay kind of like the principal and I think a bit of interest, and that's kind of like where you can also look at. I personally recommend, if it's non-dilutive, if you're looking at non-dilutive, it means that you already have kind of like a machine that's working. You just need to add fuel to the fire for it to scale more, if that makes any sense. And so if you don't need kind of like maybe the knowledge of an investor, because that's also what an investor brings, it brings knowledge, he or she brings knowledge, know-how, connections, partnerships, etc. If for you it's important to only focus on, getting more customers and just speeding up the process, and you already have a process that's working, then you can think of non-dilutive. If you want to get more kind of like connections, partnerships, and knowledge, etc., then an investor could be a potential opportunity.
I think all of this is so extremely important. So yeah, when you're talking about the cash flow, so I believe we sold it now, or it might still be in the process of being sold. But we have a buyer right now buying a business, basically with the kind of financing you're talking about. Actually, I don't know if it'd be the exact same, but revenue-based financing, basically.
Yeah.
And I know some revenue-based financing companies, they will give you like 40% of your annual revenue, and
Mhm.
it just becomes like kind of like a loan, but it fluctuates with your revenue, so which is kind of nice in the down
Yeah.
months. But yeah, like in those cases, like to your point, like don't take on an investor unless you actually need one, right? Like if you
Yeah.
need an investor for the cash flow to, like, I don't know, pump more money to meta ads, like you are probably better off seeking debt shops than, equity
Yes.
shops. But if you are seeking these networks, I'm curious on, well, two questions. So one, you mentioned giving up like 40% of your equity at the A round, like Series A, right? That seems like a crazy amount to me. So is that like common? And then the second part of my question is like, talk to me a bit about these, more intangible benefits that the dilutive investor brings.
Yeah. So on the first point, so it's at each round you have a certain percentage that you can give away maximum, right?
Mhm.
The rule of thumb is by Series A. So once you've, passed Series A or you're in Series A, that you still need to have 60% left of your equity in the company.
Okay, so they're not. Most people aren't giving away 40% of their
No,
equity.
no, no, no,
I'm
no,
like,
no.
man, that seems like a lot for 500K. Like a lot of VCs are getting rich on this.
No, you still have to have 60% left at least by Series
Gotcha.
A of your equity. So all, let's say the 40% in all, let's say those three rounds need to be divided in a way that obviously you're going to still have the 60% left by Series A, if that makes sense.
Yeah.
Again, rule of thumb, it doesn't happen always, but like if you take that into account, you're going to think differently also in how you're going to structure the rounds moving forward, if that makes sense.
Absolutely. So talk to me about these intangibles that investors give. I've heard this phrase and I do believe it, but I have never seen it like in action. So like, investor gives you your pre-seed or whatever round it is. Like
Yeah.
what kind of other things are they bringing to the table outside of that capital?
Yeah, so lots of so I have an example. So we raised a smaller round for a founder based out of Europe, and she is making our app, or she's made an app. And so the investor not only invested in kind of like making this app for her, but he's also bringing his network. So he has a network of people that are also focused on the industry or niche that she's focused on. So know-how, right?
Mhm.
Know-how in, okay, like you're building this app. Okay, I have people that, have built similar types of apps before. Let's, strategize in how we can actually build this app in the most efficient way or most effective way, for example, based on the knowledge that they have. That's a tangible example. Also, other opportunities are sales opportunities. So in this case, she also got the opportunity to start actually building the app with kind of like the network of what he has of IT people, but then also having the ability to sell products because she already had a product before. So opening those doors to partners where she can now actually sell those products as well. It was a product and became an app. And so those are all intangible parts or things where you can actually, have an added value with an investor. So it's really opening the doors to sales opportunities, to partnerships, maybe to IT and developers where, you don't have to pay kind of like the most premium price, but because they're, through the network of the investor, you have kind of like a discount or whatsoever. So things like that that actually help you move forward or help you build the platform that you want and move that forward in a faster way. That's where an investor could potentially help. And again, it really also depends on the type of investor because some investors just invest the money and then they're like, okay, you just do whatever you want to do with that.
Come back to me when we're rich.
Exactly. And then you have other investors that are really involved with kind of like the full process. So it depends on what type of investor you're also looking at.
Yeah, that makes sense. And I think it's like a lot of entrepreneurs that I know that have, raised money, they're so like, pick me, like, please look at the, like this due diligence of me and like think like I'm the best, right? But I think it's worth an entrepreneur's time to also like vet the investor, right? Because like
100%.
if someone's just going to give me capital in most situations, and I wouldn't say all situations, I wouldn't prefer to give up any equity, right? I would prefer the
Yeah.
debt service than the equity because equity is the most expensive thing you can sell, right?
Yeah.
So I think that's all very, very good for the entrepreneur to vet the investor as well. When it comes to raising this type of money, like you've done this, at least a few times, right? So you probably know what would be the common like myths and misconceptions a lot of founders have about this.
I think one of the common misconceptions is that they need to be perfectly ready when it comes to kind of like, their solution. To give you a bit of context, a lot of the founders that we work with are, like they've done development and then they started to develop this kind of like solution and then they went into the founder role, but they still have the hat on of a developer, if that makes any sense. And so what we're seeing is that a lot of developers want to have the perfect solution, or they don't want to go out and present the solution to the world or to investors, if that makes any sense, because it's not perfect yet, etc. So I literally have a client that I helped, and we've gone through the full process, teaching of the process and fundraising, provided all of the materials, all of the connections as well. And so he just needed to go out into the network and pitch. And he is still kind of like holding back because he's still wanting to work on the product up until it's like perfect and things like that. And that is something where I'm like, again, I understand that it needs to be perfect, but you do need to get into the conversations with these investors now, actually 6 months before you actually, want to do it, because it's good for you to have these conversations already so that you can already get some feedback like, hey, these are the things that you need to take into account. These are the things that you need to focus on, if that makes any sense. And so it's important to kind of like take out that thought about it needs to be perfect. Yes, you have a minimum viable product. If it's working, there's still some bugs. Okay, understood. But what is the bigger, and again, what stage you're at, right? Let's say you're in the pre-seed stage. What's the bigger picture? You need to sell the team, the vision, right? Those are the most important aspects that you need to sell from the start, especially at that stage. If you don't have a solution, or if you just have a minimum viable product. And so those are aspects to take into account. I think that also a lot of founders think that finding investment is hard. I'm not going to sit here and say that it's very easy, but there is an easier process than what founders usually think, because there's a lot of moving parts when it comes to fundraising. You have to obviously know what the full scope is and the strategy is for you to efficiently be able to raise funds. And so one of those kind of like myths and misconceptions is that it's hard, but it's actually pretty easy if you follow the steps that we provide strategically and efficiently, of course. And also what we're seeing is sometimes it's difficult to, sometimes we get founders that think they know everything, or they've pitched before and their pitch deck is perfect, etc. And I have seen thousands and thousands of pitch decks. I actually review a lot of them, me and my team. And so we know what works. And so we sometimes get founders that think they know better, which is fine, but it's going to be very hard for us to actually do our work and help you to get the best outcome if that is going to be kind of like the mindset of like, yeah, we already did the pitch, like, yeah, we already did this, okay, no problem, let's just go over it, see what we can actually improve. Because most of the times than not, we do see things that need to be improved, even though the founders say like, yeah, they've done everything already before. So yeah, those are three things that I would say are kind of like misconceptions or concepts.
As a business broker, I resonate strongly with the founder thinks they know better.
Yes. Yes.
So we sell a lot of businesses like e-commerce, affiliate, SaaS as well, of course. And I've always found, and sorry for my SaaS fans, I've always found the SaaS entrepreneurs to often be somewhat more delusional than my other entrepreneurs. Like they'll just think they're going to get this like massive Silicon Valley exit when they have like a
Mm,
$2,000 a month like cleaning app that's been around for like
mm,
8 years, like never hit momentum or whatever, right? So often
mm.
the valuations is where their mind is breaking down. And so I was curious. I mean, you kind of answered my question with that answer, but I was going to ask you, like, do you find like this kind of unrealistic expectations with a lot of SaaS founders as well when they go to raise money? Because from my perspective, it's like when they're raising money, they're willing to like do anything for the raise and like they're like, yes, yes, whatever to the investor, like give up all this equity or whatever. But then when it comes to me to actually like, hey, I'm going to make you a multimillionaire. They're like, ah, no, this valuation is way too low. Like, dude, I'm about to give you $8 billion. What do you mean?
Yes.
So I was curious if they're like that on the front end too.
Yeah. So when it comes to valuation, so your question is if like founders have I guess, a nice imaginative dream about what their valuation is.
Imaginative dream is probably a nicer way to put it.
I mean, we've definitely come across those where, like Sometimes it's difficult to pop the dream of a founder, right? But we do need to be realistic. So I'm pretty direct. So I don't, beat around the bush with those types of things. And what we usually do with valuations is that we have a team that basically does that. But what we do see, or what I do see when I hop on calls with founders, is that there are sometimes, yes, it's where the valuation is so much bigger than where they're currently at. And sometimes they haven't done maybe kind of like the pre-work to understand how valuations work. Or, online you can also find some tools to just get like a little bit of an idea of where, your valuation is, or kind of do some competitor research and then include that in what you're currently doing. So yes, we definitely have come across founders that, where the valuation is a little bit skewed, but like I completely understand they believe in the dream, but we do also need to be realistic and make sure that, for the investment that you're going for, that's also something that works. And again, depending in which region you're at, valuations differ in that sense as well.
So for people who are beyond pre-seed, I kind of get what an investor might be looking at, because it'd be similar to like a buyer buying a business from us, right? They would be looking at
Mhm.
a lot of similar metrics. But for a business that, hasn't really hit any revenue yet, and they're trying to go raise that money, are there certain like KPIs or some sort of metric the investors are looking at? Like, is it really just vision? Like, is that what they really care about? Like, walk me through like what makes
Yeah.
someone an investor and not.
Yeah, it really depends on the type of investor, because like in those stages you can look at high net worth individuals, you can look at family offices, you can look at angels, so you can look at pre-seed VC firms as well. Each kind of like, I guess, in type of investor has kind of like different prerequisites. For VC firms, obviously they have kind of like their prerequisites. Yes, it's the vision and the mission and the team, for example, but maybe they have all other prerequisites as well, like what's kind of like the financial prognosis, right? What we've seen with our experience, it really depends on what type or who the VC firm is, because every VC firm has different prerequisites, because they also have different niches and industries that they focus on. So it's not always going to be the same, but they do have more kind of like prerequisites when it comes to investing in the pre-seed stage. Now, when it comes to, for example, angels or individuals, family offices is also an aspect. They see it a little bit less stringent. Obviously, if you're an angel, it's usually more of, are you familiar with the industry, right? So if you're a founder that's in health SaaS, then the angel hopefully is also going to have that background, and then they're going to understand a little bit more. And that, let's say, angel investor is going to understand not only the industry, but also, okay, does he or she have the vision, the team, and all of those other aspects? And it's also a little bit of a feeling intuitively if they can also add value, which is a little bit intangible. But there's like, those are kind of more of like the basic aspects. It's also going to be, for example, yesterday we had a conversation, a client of mine with an investor, and this investor is more of a tech guy. So he's a developer from kind of like his background, turned into angel investor and turned into kind of like venture studio. And so this investor was really focused on kind of like more of the technology behind kind of like the solution, more than kind of like the sales and the revenue and things like that. And so that's an example of an angel that has kind of like more of a, maybe a technology kind of background. So you adapt kind of like your pitch, you adapt everything to that more technology part. If it's an angel, for example, that has experience in, let's say, health tech, let's keep this example, but is more focused on kind of like sales and marketing, then they're going to focus more on kind of like, okay, what's the vision for the sales, what's the vision for you guys moving forward, what's the financials in a year, 12 months, 18 months, etc. So it really depends, again, like what type of individual you have in front of you, what type of investor it is, and knowing a little bit of their background, you can adapt that to what they need. And again, that's also where it comes in, like what is important for this individual. Obviously, in the pre-seed stage, yes, vision, mission, but they have their own kind of like prerequisites and questions that they have in their mind that they're going to ask the founder. So it's really individually based, if that makes sense.
No, it totally does. Just keeping your marketer hat on, right? Like adapt for the target audience. I say that to sellers all the time. Like,
Yeah.
most of our entrepreneurs, most of our founders that come to us, they have a pretty good background in marketing because it's like digital businesses,
Mm,
right? That
yeah.
tends to be their kind of core skill. But when it comes to actually selling their business, they just like take the marketing hat and throw it into the trash and like not thinking about
Mm,
the buyer. Like they're just thinking about how much money they're going to get. Like, well, the buyer's also risking like, hundreds of thousands to millions of dollars here, right?
Yeah.
Like let's think about what they want as well to get a better deal here. But when it comes to like mistakes founders make, would you say that's like the biggest mistake, not like adapting to the type of investor, or do you see another mistake that's even bigger that founders should try to avoid when pitching?
When it comes to pitching specifically,
Yeah, pitching another investor.
I mean, I literally have an example of a founder that we were coaching. So this founder had a sales and marketing background. He had an agency that he built up to X amount of millions in revenue. And so he wanted to build a new product alongside his agency. And so when he hopped on board with us, like we told him and we coached him into like, this is what you need to do. We actually found an investor for him. And so we set up the first meeting. And before we set up the first meeting, we coached this founder and told him, listen, like, this is going to be the profile of the investor. Take into account that, speak like this, highlight these aspects in your pitch, et cetera, et cetera. And so he literally said to us, like, don't worry, like I have it. Don't worry. I don't need any more feedback. Okay, cool. No worries. Okay, so next step was we organized the meeting. We were in the meeting with him, and then literally from the start that the meeting started, he spoke like I think 10 to 15 minutes straight. Like I think he was nervous personally, but he was just speaking, 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 and usually depending on the meeting, but let's say it's an initial meeting with an investor, sometimes it could be 10 minutes. It's very introductory. Sometimes
Right.
it could be 30 minutes, really depending on, again, which stage, what investor, etc. But in this case, he had like 30 minutes, I think, spoke
Oh, that's
10
a long
minutes.
time for an intro pitch.
Yes, exactly. Because we already
Very rare
sent
to get one. Yeah.
information beforehand, we set everything up, and etc. And so he spoke for 10 minutes straight. And then after that, the investor was kind of like taken aback. And so the meeting was cut short, obviously, because there was no kind of like interaction. It was like just, straight on talking, talking, talking.
A whole
And I'm not
100% pitching. Yeah. That's
exactly.
too hard sell pitch.
Exactly. And sometimes it is nerves, and I completely understand. But, like if we're providing you best practices, and this is also the thing with having an open mind, specifically, especially in these types of things, having an open mind and really understanding that you're not going to know everything. We don't also know everything, but we have the experience and we know from kind of like knowledge what works best. And so we share that. If you want to implement that, then obviously you're going to get better results. But if you don't want to implement that, then you're going to get this experience where, we set you up on a meeting with a great investor. It's a great opportunity. And then you just blow it. And then it's kind of like, not because of your experience, but because of ego and thinking that you can handle everything. And so this is one thing that I do want to kind of like share with a lot of founders is, put your ego on the side and just, be open to feedback, but also be open into understanding that you're not going to know everything, but we as partners are there to actually help you through the process and make sure that at the end we all win, if that makes any sense. And so that's a very important aspect to really communicate.
You just reminded me of, so I was in this mastermind at a conference. I think it was a year ago, maybe a year and a half ago. And I was at this table with these other founders, like minted, they've done really well for themselves, all bootstrap. And
Mm.
they asked me, they're like, well, so what's your problem, Greg? And I was like, well, and I was just curious. I threw out my big problem, like, how would I raise $100 million? And that was the question I asked them. These guys are like not worth 100 mil, but like high eight figures for the most part, and they all like had no idea what to do. So I like put the scenario together. Like, okay, let's say we're like in a room with the investors, and we're pitching them to like raise this
Mm.
money, right? And we mentioned that we outsource to the Philippines, and one of the investors asks us, "Well, why not India? Like, what would your response
Right?
be?" And the
Exactly.
entrepreneurs, I think you can probably guess where I'm going with this, but the entrepreneurs at my table, they responded like, "Well, I would describe why the Philippines is better English, or blah blah blah," like all these justifications, right? And I told him, like, this is the problem with you being an entrepreneur and not working for someone for a long time, because that is completely the wrong answer. The right answer, in my view at least, I'm curious in your thoughts, the right answer is looking at that investor and say, I think that's so interesting you brought up Indian outsourcing versus the Philippines. Once we get this funded, I would like to sit down, have a coffee with you and go over it, because maybe you're seeing something I don't. Because a lot of times, like, what's going on, like, what's the question beneath that question, is that
Yes,
investor just invested in an Indian outsourcing company and he needs to
exactly.
make this look good to the other people at the firm, right? So he doesn't want to hear your justification. It's like at all.
Exactly.
But like then that
Exactly.
meeting never happens, right? But it's like glossing over it, right?
Exactly, exactly. And it's super interesting because usually, and this is also what I've learned in sales, is like when a question is asked, it's like what's underneath that question, right? It's
Right.
just kind of like wanting to have reassurance or wanting to understand something. And so what you can also do is like, oh, interesting that you're referring to India. Is there a particular reason why you're referring to India? So that you can get his thoughts on why it's India. And then when you get his thoughts, you can understand, okay, so he functions like that. Okay, how can I
Right.
adapt? Like how can I adapt this more to that? And so these are like small aspects, but are huge differences in where you can actually understand the investor's mindset. And this is a great point, Greg, that you brought up. Understanding the investor's mindset and understanding who this individual is and what makes him tick or her tick, right? You're not going to get all the information beforehand. You can obviously, find information where they've invested in, et cetera, et cetera. That is, I guess, standard for us, standard process. But it's also you getting this feeling and this connection with the investor when you are on the call with him or
So
her,
important.
right? And that's important because you want to connect with an individual. It's not like, oh, well, he's only, or he or she is only here to provide us money. No, it's like, who is this person? And this is with everything, not even investors. This is with everything in life. If you
Yep.
connect sincerely with a person and try to understand that person, that's where you're going to get kind of like more from them and hopefully add value to them as well. And that's kind of like my thought process and everything. Like, how can I add value and how can I understand that person even better to add more value to them? And that's also going to reciprocate that back.
That is, in my view, is like one of the most important things. Like we've sold businesses where the seller took $200,000, $500,000 less than the other offer simply because they liked the buyer more. They thought
Yeah.
they trusted the buyer to continue their legacy, right? And a lot of times that's like when an entrepreneur goes sell, it's almost like giving up their child, right? It's like their
Yeah,
baby,
a hundred
right?
percent.
Entrepreneur postpartum
Yes.
depression, right? So
Yes.
like I 100% agree, and not just in fundraising, but all aspects of business and life, like so key, important. So I know we're running up against hard stop, but so I want to ask you this question before we get into the rapid fire section. It's kind of the opposite of my previous question. So we now know, like, hey, you go put that aside, but on the opposite side, what goes into the anatomy of like a really good pitch? Like, what is the best practices?
Yeah. And this is interesting because I literally had this pitch session with one of my clients this morning. And so, again, depending which stage they're at, let's, for simplicity reasons, say the pre-seed stage. What we would recommend is it's kind of like how it's in the pitch deck. You have, and depending if it's a 1 minute pitch, if it's kind of like a 5 minute pitch, if you have to do it in front of different investors, but let's do kind of like a 1 minute pitch. What we recommend is to focus on storytelling, but storytelling in the sense of the vision, the mission, and the team. Those are the three things that are super important at that stage, because at that stage, again, you might not have a platform in place, but you need to sell that vision. And so it's good to kind of like reference maybe kind of like current companies. Okay, let me give you a concrete example to make this concrete. We have a company that has a platform that's kind of like the Uber for taxis, right? And so what the founder usually explains is like, hey, we have taxis that, individuals can rent and then do taxi driving and then obviously earn money, right? But instead of saying that, you can say, well, we're actually the Uber for taxi drivers. And so you already connect both of those aspects in one that people are going to understand immediately. Okay, so they have the Uber, but it's for taxis. Cool. And then you can actually start talking about like, if it's the founders, we come from this and this and this background. Our vision is to do this and this and this. And we are searching for, I don't know, 300K, 500K, 700K to invest for, et cetera, et cetera. So those are kind of like the elements that you can have in a pitch where it's really about building the vision, building the mission, and who is behind that. Now, when you're at the seed stage, which is a little bit more further along the process, it's really about, okay, we've built this. What was the impact that we've had or the problem that we solved? The impact that we're having, and where are we going next? What are the milestones? Revenue wise, depending on, again, what type of investors you're looking for, but also, what's the vision building further? What are the next steps technology wise? Maybe kind of like focusing on, the building blocks of the technology as well. So those are kind of like aspects to kind of take into account, but it really, again, we check individually with each founder to kind of see what are the main important aspects that we need to take out. But those are kind of like the things that you can take into account, whether it's in the pre-seed or the seed stage.
Yeah, storytelling extremely powerful, especially when you only have like 5-10 minutes, which is often what these pitches are, right?
Exactly.
Got to condense it down. It's like a Google AdWords ad. So,
Exactly. Exactly.
I know you got to run, but before you run, I would love to do the rapid fire section where I ask you 3 questions and you give me 3 quick answers. Are you down?
I'm ready. Let's do
All
it.
right, let's do it. In your view, what is the best hidden growth opportunities for an early stage SaaS founder?
Growth opportunities where they can invest in, or
Whichever way you want to take it. It's an open-ended question.
okay, I'll say, but this is so typical AI.
I mean, you're not wrong.
I know
Yeah, 100% right.
it's a really buzzword, but I'll say AI. So there's so many caveats here.
This came close to being the first podcast I've done in months where we didn't talk about AI. I'm glad we got it in there. Thank you, Denise.
Right?
All right, second question. What tools or resources can people use to help grow their early stage SaaS?
I would say specific tool. I'm a fan of tools where you use AI to start developing. So that could be any type of tool, but I'll just keep it general, kind of tools that can help non-technology founders build applications. I would say that. It's an amazing, amazing opportunity now for
Oh,
non-technical founders.
absolutely. Absolutely. All right. Hardest question, but the most important question in the entire interview. What has been your funniest moment working with SaaS founders?
Funniest moments. Oh, that's a good one. I have to think about that.
It's not a good answer. We can't publish the podcast.
I
Yeah,
know, right?
no pressure.
Wow, that's a great question. Oh, I have to think about. I don't have an answer for this one. It's a good question. I am gonna simmer over this.
But when we sell your business, maybe that buyer will know the answer. Like that'll be part of the package.
Right?
So you sell your consulting business with Empire Flippers, and that buyer will get the answer to that question. I think that's a pretty good CTA. What do you
Right?
think?
Exactly. There we go.
For the audience, I've been hard selling her before we started recording this. I just like had to end it on a sales pitch. But if someone wanted to pick your brain and like get to know you a bit more and learn more about their like funding options, where should we send them?
Yeah, you can go to my website, saaslaunch.io, or you can find me on LinkedIn, Denise Edwards. And if you put Denise Edwards SaaS Launch, you'll find me directly because otherwise you'll see different people. And you can email me at denise@saaslaunch.io as well.
Awesome. Well, thank you for coming on. It's been an absolute pleasure. I feel like we could probably do a round two, sometime in
Right?
the future.
Would love to.
Awesome. Well, thank you for coming on. For everyone, if you want to get in touch with Denise, all the links and all that good stuff will be in the show notes. Oh, thanks, Denise.
Thanks, Greg.
There you have it. I hope you enjoyed it. I hope it got you inspired at all the different things that are happening in this industry. And of course, if you just want to buy a highly profitable business, you can always go to empireflippers.com/marketplace, or maybe you want to make an exit of your highly profitable business, and you could go to empireflippers.com/sell your site. I've been your host, Greg. If you enjoyed this episode, make sure you leave a review, give us a like, a follow, share it across social media. Talk to you all soon. See you on the next episode.